So today the market's a little bit quiet with not much news out there as we wait for the inflation data, so I thought today would be a good opportunity to take a look at a stock. And the stock that I picked is Fiverr. This is a stock that I've been interested in for a while, and I thought I'd share my thoughts with you guys if I think it's a buy or if there's something I want to see change in the business to make it a buy. So I hope you enjoy it. If you could, smash the like button, and by the way, I have got a new microphone on today's video, so hopefully you can tell the sound quality difference as well, because it's been a little bit iffy the last couple of days because the microphone kept cutting out at a few points during the last couple of videos, so hopefully that is a little bit more improved. But let's take a look at Fiverr. And just a quick little plug, if you do want to get some free shares worth up to £100, join Trading 212. That is the broker that I currently use myself. It's a great platform, so if you do want to join it, link is in the description. But let's take a look at Fiverr. So before we do anything, let's just have a look at the stock chart. Ticker symbol FVRR. You'll see here it's currently a $26 stock. It is a 1 billion market cap, and you can see the 52-week close was $23, so it's pretty much near its 52-week close. If we do zoom out on a longer time frame, we can see here the stock did IPO in June 2019. The stock IPO'd at $31. The stock went a little bit down after its IPO, but from that time frame, the stock rallied up during 2020 into 2021, as it was a stock that really benefited from the CV situation. And this stock, believe it or not, was $323, and now it's $26. That is a big drop. We can see down here that means the stock is currently down 91% since the 12th of February. And really, obviously 2021 was a big pullback, 2022 was a big pullback, but even in 2023, where we've seen some stocks start to rebound that had such a surge during the boom of the CV times, even 2023 has been a tough year for this stock. And now at $26, it does mean the stock is actually before the CV times. If you do go back to February of 2020, it is down before the whole CV situation. Now, obviously, most of you guys probably know what Fiverr is. Fiverr is a freelance service. So if you want to offer freelance services, you can post on here saying, I can do this role for you. So if I wanted to have some YouTube thumbnails created, I could search for someone that creates YouTube thumbnails, or you can see the popular ones like web design, WordPress, logo design, AI services. So if you wanted to get someone to do his job for you, you go on here, type in what you want, and they'll be able to offer you a price for what you want doing. So if we click website design here, we get all the services coming up in the background. If you can ignore this little pop-up here with the rating of the seller, how much it would cost you. And this is a really good service, because if you were someone that just wanted a one-off service, if you were a company and you go, you know what, we don't want to employ someone in a full-time role, we don't need them 5 days a week, but you can go on here and get someone to do it online, obviously that would be something really ideal. And as well as that, the people that are working on Fiverr, you know, some people want to get more money, have their own brand, get people to come to them. So this is a good marketplace for people who maybe don't want to have a full-time job in one place, able to maybe choose the work that they take on. And obviously work at home, we've seen a big boom in that as well. So this Fiverr and a freelance platform works for the companies or individuals that want work doing, and also works for the people that do their service on the platform. And personally for me, I've used Fiverr a couple of times, and I actually find it a really, really good platform. So I'm actually a fan of the platform as an actual user. Now, obviously we talked about the share price, and you can see here it's being beaten down massively. Just to show you the surge that it had on that, because obviously people went to working online, freelance work went a little bit crazy. If we do look at the past performance, and you actually see the demand that was pulled forward from that time frame, in 2020, or the end of 2020, the company was doing 107 million in revenue. Now, it was loss making, losing 34 million a year. You can see here, if we do go to where they are at right now, they're currently 343 million in revenue, and the losses have gone down by half. So they are currently not profitable, which is a little bit of an issue, but the losses have come down, but the revenue has over 3x in that time frame. So there is suggestion that there has been a lot of demand pulled forward. And that's actually quite clear when you look at the revenue growth. If you do look at the revenue growth right now, you can see here they were growing in 2018 44%, 41%, 76%, 57%, which are all really good amounts of growth. Now the problem is at the moment you're sitting at 13% growth. Now that's not really going to attract many investors in, especially if you're a loss-making company, because one of the big things that you'd be saying as a loss-making company is if you're a growth stock, well, eventually scalability will get you to profitability. Now the problem is this isn't going to be attractive to growth investors because you haven't got much growth, and it's not attractive to value investors because you haven't got the profitability. And there lies one of the issues that currently Fiverr have. Now you would expect the freelance service to be a growing industry in the next few years, which is a positive, and they currently do have 11% of the market, which suggests they will have a good chunk of the market to go for. At the same time, the moat around here could be a little bit controversial because maybe when you're on Fiverr you would carry on using that platform, but it is quite competitive out there between the freelance platforms. If you look down here you can see a list of including Upwork, which has 23%, on the site 13%, people per hour 12%. Kaggle, which I've never even heard of, is 11%. So you can see here there is a really fragmented market out here. You could argue there's market share to go for, but you could also argue there's a lot of competition out there at the moment. And if you do have a look at the analyst forecast, you can see here they are expecting EPS to go from 0.26 to 0.45, and from the current year 0.71 up to 176, and also improvement in 2024. So the EPS does continue to grow in this company, which is good. And if you do look at the revenue, there has been the slump in revenue where it's going to be 7%, which is a lot lower than what they've normally done. But you can see next year there is actually going to be a rebound to 16% growth. So maybe they are starting to get over the tough comps here, but a big jump from 7% to 16%, I would like to see that actually being shown as proof that the growth is coming back here. Now the recent earnings once again had a good beat on EPS. Revenue was a little beat. 5% revenue growth though, which was a little bit of an issue. But if you do look at the guidance update, they updated the guidance in the recent quarter and increasing the midpoint of their revenue guidance and also raising the adjusted EBITDA guidance. If you also look at the longer term targets they were offering, if you look at Q3, there is going to be a big improvement from the 5% that was in the last quarter to 8 to 12%, which is pretty good improvement. But the slow growth at the start of the year is going to hold back the full year numbers. But the suggestion is that the growth is starting to get shown a little bit when you look at that Q3 guidance, which is pretty good going. And when you look further down the numbers, you can see the growth in the revenue. Now, you would not believe it, but the gross profit on this company is insane. So they make 89 million, but the gross profit is 73 million. So you're probably looking at it earlier going, well, how is this company right now losing money when you've got them sort of gross margins? Those gross margins are absolutely crazy. Well, research and development is a little high at 23 million in my opinion. I think that really does need pulling back a little bit. And the G&A as well is at 15 million. Same again, I think that's a little bit high there. So they do need to control these costs a little bit more. The big problem they have is that sales and marketing, even though it did go from 44 million into 38 million, so the growth in the company isn't being supported by increasing sales and marketing. In fact, the revenue is going up while sales and marketing is going down, which is pretty impressive. The problem is that when they do have 89 million, nearly 38 million of that revenue is coming from that sales and marketing. That's a little bit of an issue. When you are having to commit nearly half of your revenue to sales and marketing, it's a little bit troubling. And that once again goes to, is this market that Fiverr in a little bit of a fragmented market? Is the moat a little bit weak? Is there a lot of competition in there? And that's a little bit of the issue that we do have with Fiverr at the moment. Now, if you do look at the growth from analysts is suggesting for them to get back to double-digit growth, which is good. You can see the analysts are forecasting them to hit profitability next year with 8 million, and they are going to hit profitability in 2025 of 36 million, which is good that the growth is suggested to come back and they are going to move into profitability. Now, the only problem is, like we said, the company is around about $1 billion market cap, which is a little bit worrying about how much valuation here is already priced in. Although I would like to add that Fiverr does currently trade on a forward P ratio of 12, which is very attractive. But same again, it's not granted to deliver the profitability and the EPS just yet, which is where the little risk would come from. So I would like to see that improvement being shown first rather than take it for granted that they are going to hit the forward P ratio of 12. When you do look at the balance sheet as well has got a little bit weaker since 2020. They did take on 360 million of debt, and that has now gone up to 445 million debt, which is about half of the market cap, which is a little debt heavy, I would say. They do sit on 427 million of cash, which is pretty decent to be fair, and does cover most of the debt. But I don't know if the debt is a little high, being half of the market cap, maybe a little bit of a high debt there. Insiders have not been buying shares, which I thought they would do considering how low the share price is. But there is good insider holding, as the main shareholder is an independent director and a member of the board of directors. And the actual co-founder and the CEO does own 4% of the company still, which is still a pretty decent holding. So my overall thoughts with Fiverr is that I am a fan of the company. I do really like the platform. I think the platform is very good. I use it myself and I would continue to use it. The next question is about the stock. Do I like the stock? And I think the stock is actually okay. I think it's the most attractive it has been since 2020. But the problem is there's definitely still improvements that you want to see with the stock. Now, granted, the balance sheet is not as good as what it was in 2020. My problem would be around the valuation and the growth. If they can get back to double-digit growth, I think that is fantastic. I think that's what we want to see. But I think we need to see that happening. So I would give it a couple more quarters to see if the growth does come back. The next big question you have is the amount of profit they're going to be able to do. I think if you are going to only see 8 million profitability next year, I think that's a little low for a company that is nearly a 1 billion market cap. And then you have to wait another 2 years for 36 million in profitability. I think if you were to see this company come attractive, you really want to see this around about a 1 billion market cap, but you really want to see the company putting in over, in my opinion, 50 million in profit in the next 2 years. And the other thing is that we've not actually seen, even with the big boom they had in financials, we've not actually seen them be able to deliver this profitability. So my big question is, can they deliver it? You look at what we showed and the cost they're having to put into sales and marketing, and when you've got these gross margins, you would expect a company like this to be profitable, and it's not. I think this company has maybe too much competition at the moment, and that's taking the toll on the profitability and why the sales and marketing costs are a little bit too high. So for me, the two things that I would like to see is this company go back to growth or higher growth than what it's doing right now. I'd like it to prove that it can hit profitability, and for the profitability to get to a little bit higher than where analysts are forecasting at the moment for this valuation you're paying. When you consider those challenges that you see the company has to do at the moment with higher growth and more profitability, right now there's a lot of stocks at the moment that are already doing that higher growth and already have that profitability and are at the kind of same valuations as Fiverr. So I do like the company. I just don't know if I like the business enough to buy. I think I could justify there's a couple more better businesses to own out there than Fiverr, but we'll keep it on a watch list. And if they do deliver good revenue growth and the profitability does ramp up and they do sit at 1 billion market cap for a little bit longer, I think then it would come an interesting opportunity. So I think for now, for me, it's an add to a watch list and come back in 12 months time and see where they are at with delivering the improvements in the financials. Hope you enjoyed the video on Fiverr. If you could, smash the like button, and I'll see you in a bit. Although I would like to add that Fiverr does currently trade on a forward P ratio of 12, which is very attractive. But same again, it's not granted to deliver the profitability and the EPS just yet, which is where the little risk would come from. So I would like to see that improvement being shown first, rather than take it for granted that they are going to hit the forward P ratio of 12.